The S&P 500 was down half a percentage point, but if you were on Twitter for the last 24 hours, you would think that the world is falling apart as stock market crash was actually trending. So is this just a pullback and some seasonal weakness, or is something more sinister occurring under the hood? Let's talk about it. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit the notification bell. Let's get into it. It was quite the day of trade today. Stock market crash definitely trending. There were pockets of green in pretty much every sector. We did see consumer defensives and healthcare outperform as a whole, although these sectors were still red on the day, but the majority of the selling occurred in technology, semiconductors, and real estate put up an absolute shocking day. Looking at the weekend poll, 60% of you are bearish, 40% of you guys are bullish, and it looks like the bears are in the lead this week. A lot of you were bearish last week. It was about the same numbers, got absolutely smashed last week, but let's see if they can recover some of their losses this week, and they're on track to do that. Now, 405 votes, 12 comments. Thank you all for participating. I really appreciate the engagement we've been seeing in the channel lately. Fear and greed. 1 month ago, we were in extreme greed. We were at the 80 level. We're now actually approaching neutral territory in the fear and greed index, and that's how quickly market sentiment can shift. Now let's dive a bit deeper into the stats. This is something I've been showing you. It's the bullish turn of the year barometer, and a bullish signal is triggered when the November 19th to Jan 19th is greater than 3%. Currently, we're sitting at 4.99%, let's call it 5%. And unless we drop 2% in the next 2 days, we are gonna have a bullish trigger, and very possible we definitely can. We normally see about 3 or 4 2% one-day drops in every single year. But as it stands right now, we are about to trigger this turn of the year signal, and it is the best signal. 37 hits, 2 losses, 92% win rate, 15.67 average return. Very, very bullish if we do go ahead and hit it for the year ahead. Looking at the majors, and we saw quite the dip buying. I mean, things were looking really, really brutal at about 12:30, 1:30, and then we saw a huge amount of call buyers lead the tape higher and pass so much losses. I mean, right here, look at the IWM, look at the RSP, right? Down more than 1 percentage point. RSP and small caps down 1.5%. To really pull out the numbers we saw right here, it was quite the bullish action midday. Maybe some buy the dip opportunities, probably some dealers unwinding their positions too, but this is what we expect in negative gamma. We see these large swings in price, whereas in positive gamma, we normally just see very muted action on the way up, on the way down. But all in all, everything was in the red. Bonds, Nasdaq 100, S&P 500, small caps, the market as a whole. Now, looking at January seasonality, this is where we are right now. Now, I don't know. Now, this is a composite cycle, and you can see that normally January in the last 20 years has actually been pretty flat. This is where we are right now, and we are actually tracking ahead of seasonality. So if we do go further down towards the mean right here, that's to be expected. All the market really does is just revert to its mean over time. Now, looking at today's volume, and this was the second day in a row of an 80% down day in the New York Stock Exchange. We had 711 advancing stocks, 2,125 declining stocks. And normally when we've had 2 85% down days or more, followed by a 52-week high made in the last week, it's actually very, very bearish when you look at it. 12 months later, average return of about 6%, only higher 50% of the time. Average max loss 11.6%, average max gain 13.6%, and the risk to reward 12 months on is not quite there. And it's very similar stats, 1 month, 2 month, 3 month, all the way to 12 months. So there are risks building into this market. Now let's dive further more into breadth. Now there are some tactical risks coming into the market. We could see that the percentage of S&P 500 stocks above their 10-day moving average is actually going lower, and you can see here that it remains on a bearish tactical signal for market breadth. This is both for research. Similarly, S&P 500 stocks above their 50-day moving average, we can start to see it begin to roll over, and both see the first leg of support at the 46.11, very similar to an area I've been talking about over the last few days. So we could probably see percentage of stocks roll over more to the downside as we get to this area right here. Now let's move on and talk about sectors. Almost every sector there was a dip right here, sort of around the 130. And then we did go higher, but all in all, even the leader today, Staples, was down, well, flat, I guess, but down 0.07%. The worst sector, GDX, 3.1%, and I believe it's down 12% for the year. So something definitely going on with gold miners, and I think it has to do with rates. There was a lot of optimism on rate cuts, and that has now faded after retail sales. We got retail sales today. Headline retail sales came in at 0.6%, core control at 0.8%. Now here is the overview. Retail sales in the US exceeded forecasts, demonstrating the resilience of the American consumer despite rising rates. Monthly increase was 0.6, surpassing the 0.4 expected. Excluding autos and gasoline, core retail climbed to 0.4, higher than projected at 0.2. And the key takeaway, guys, is the robust consumer is spending, and that poses challenges for the Federal Reserve and complicates the argument for reducing interest rates in 2024. And yields actually rose after this report, and rate cut expectations changed significantly. So we saw a massive shoot up in rates. Now the market was pricing in 168 basis points worth of cuts. We're now pricing in 140 worth of market cuts. And looking at FedWatch, you can definitely see the trend. Just yesterday, we were at 63% chance of a rate cut in March. We're now at 55%, and we have to see if this continues. And to be honest, the market did get away from itself a little bit, but all in all, we are still anticipating that 25 to 50 basis point worth of rate cuts in March. Another reasons yields spiked today wasn't just because of retail sales. We actually had a really bad 20-year auction. So yields climbed on a weak bond auction as dealers left to pick up the scraps. Dealers had to pick up 17.3% of the 20-year auction, the highest since November 2021. It came in at a 0.8 basis point tail, pricing in at 4.423%, and the 20-year did dump a little bit, but this was coming off the fact that it did gap down. Let's go back to retail sales and what it actually means for us as investors and consumers. Now, what we're seeing along with strong retail sales is the fact that real disposable income and personal consumption expenditure have remained very resilient, and Goldman Sachs forecasts this is actually going to continue at about the 2.5–3% level for real disposable income and real consumption expenditure. And if you actually use the employment cost index minus the consumer price index, this green shaded area indicates real income growth. This red area indicates income decline. And as it stands right now, consumer spending is remaining resilient, mostly because real incomes are actually increasing, and they are further expected to increase into 2024. And consumer credit is actually starting to tick up from the October lows, something we're seeing, especially as financial conditions have eased. We've sort of been in this range for the better part of a year, and we are seeing consumer financial health tick up, which is a really, really good sign. And overall credit outlook has went from 67.1 at the bottom right up to 70 where it is right now. And this is occurring both in the US and Europe. Europe is seeing something very similar. Now let's look at the UK, which is a barometer for Europe. Real spending growth and real income growth is actually increasing and expected to increase in the years ahead. Now let's actually look at Europe as a whole. All in all, Europe is actually trading at quite relative discount to the United States, 12.6 PE in Europe. And let's talk about Europe some more. These valuations are no surprise. The United States has outperformed Europe quite significantly, and this is seen on this graph right here. This is a European EPS versus the US, and the US outperformance in 2020 has actually decreased. We can see here that even though stock prices did go lower, EPS forecast did trough for Europe, tick up, and now it's trading relatively flat. And Goldman Sachs forecasts that it's going to continue to remain flat. So what does that mean? It means that the US and Europe are likely going to report very similar earnings in 2024, 25, 26, and I would assume that that goes across sectors as well. Now, I actually couldn't find full year earnings for Europe as a whole, but I did find 2023 Q4 estimates. The Stoxx 600 index, which is the flagship index throughout Europe, is going to report earnings decline of 10.1%. The best performing sectors are healthcare, cyclicals, real estate, and technology. Those reporting earnings declines are industrials, financials, non-cyclicals, energy, utilities, and basic materials. Now, what does exposure look like? Well, one thing you can look at is the granola index. It's GSK, Roche, ASML, Nestle, Novartis, Novo Nordisk, L'Oreal, LVMH, Louis Vuitton, AstraZeneca, SAP, and Sanofi. And these names are sort of the equivalent to the Mag 7 in the SP 500. These names make up 24% of the Stoxx 600 index. And this is how you can grab exposure. You can actually just go buy this granola index right here. This is what you'll get in the weightings. You'll sort of get LVMH, Novo Nordisk, Nestle, and it's a very concentrated index, but these stocks have performed very, very well since the early 90s. Now, switching gears back to the US. Now, yesterday I showed you the New York State Empire Manufacturing Index. It fell to -41. It was kind of crazy. Now, this is just New York manufacturing. One thing I didn't show you guys is that the expected seasonally adjusted manufacturing index, and we actually are seeing an uptick in that. So the headline said it was -41, but what I didn't show you guys was that we are expecting business conditions to increase into 2024. Now, this coincides with Goldman Sachs recession indicator. Goldman Sachs only see recession probabilities at about 15% right now, and they are expecting GDP growth of about 2%. Now, the consensus for a recession is very close to 50% and GDP growth of just under 1%. Who's going to be right? Who's going to be wrong? I feel like maybe Goldman Sachs have more internal data, but maybe we meet in the middle and say recession forecasts are very close to 35%, growth at 1.5%. And the credit markets are also telling us a similar story to what Goldman Sachs might be agreeing with, in the fact that corporate credit spreads are actually very, very tight right now. And that shows confidence in the economy. Even though 10-year treasury yields have increased 16 basis points in the last week, IG index spreads have only increased 1 basis point. And this slight increase in corporate bond spreads suggests only a marginal increase in perceived risk for investment grade corporate bonds. So investors as a whole are liking where the economy is sitting, where companies are sitting, and that's why spreads are very tight. This is something I wanted to show you guys, just something very, very interesting. Interactive Brokers reported their earnings, and in this paragraph right here, they said commission revenues increased 5% to 348 million. Customer trading volumes was mixed across product type, with options and futures contract volumes up 21% and 4% respectively, while stock share volumes was down 22%. So the options market, the futures market, is increasing and taking share away from commons. Very interesting stuff, and I think this is going to be a trend we'll continue to see. Now, while we're on the topic of options, Max Payne, guys, is at 475 for the SPY. Currently, we're at 472, and this is what I told you guys yesterday. Between 470 and 475, this is where we're going to trade for the rest of the week. And how do I know this? Well, because based on OPEX week, you could see that the average return was about 0.072%, and that's where we are right now. That coincides 470 to 475 SPY, and you can have a look at this data right here. Now, here is gamma, the gamma structure for the S&P 500. Not much has changed, except we did move gamma flip zone to 47.65. Now, we are trading slightly below this area right here, and we are currently in negative gamma. And you could see that the end of day gamma from yesterday to today, we have shifted quite heavily into negative gamma. But after the 25th of January, we do shift into more neutral gamma. Some days are negative, some days are positive, but the next 2 to 3 days are going to be quite intense, especially as dealers unwind their hedges. Now, looking at the gamma heat map, and this is exactly what I said was going to happen. We can see that this neutral gamma zone right here has increased significantly. I believe it was only about this area today, and as dealers have unwound their hedges and we saw more negative gamma come into the tape, this has actually expanded and expected to further expand, and probably even you might see some huge pockets of negative gamma come into the gamma heat map over the next couple of days. But let's look at some charts, and a lot of people bought the dip right here in the S&P 500. I do get it that a lot of dealers were unwinding the hedges and so forth, but the big OPEX is only on Friday. So a lot of people bought the dip right here. We did gap down and it was a negative day, all things considered, but a lot of people saw this as value and are buying the dip right here. I'm still under the impression that as long as we stay above 4,600, all dips should be bought, but maybe we wait for lower price action. Maybe we do go a bit lower, especially as we have entered into negative gamma. And I'd love to see if by Friday, if we close below here, it probably means we go lower. But if we do stay above this area, man, this is going to be very, very constructive for bullish action looking ahead. Now, looking at the equal weight, and you guys know that I'm bullish above the 155 region. We've actually had a daily close below, significantly below, as we were right there. We gapped down. Dip buyers did come in. Now, the next line in the sand we need to look at is 149, but this is not looking too good for the RSP. And maybe we do get to this area right here. Maybe the market cap might not because of the strength we're seeing in semiconductors, but maybe the equal weight might get to this level right here, especially as earnings have, well, the financial earnings haven't been as good as we thought they were gonna be. Now guys, data tomorrow, we had retail sales. Tomorrow we have housing starts, building permits, initial jobless claims, existing home sales, and then Michigan consumer sentiment, I believe, on Friday. But if you've made it up until here, guys, thank you so much for watching. Guys, please subscribe to the channel, like this video, leave a comment, and hit that notification bell. Cheers.